Are you an overwhelmed SaaS founder ready to make the leap from leading a team to leading an organization? Join us each week as we refill your think tank with actionable tips and strategies from great business minds you know and those you don't know yet. This is SaaS Fuel with your host, 5-time entrepreneur, SaaS founder, and globetrotting adventurer, Jeff Maines.
Welcome back to the SaaS Fuel podcast, where we play the thrilling game of guess the SaaS subscription cost, where the rules are made up and the points don't matter because it's all going to change next quarter anyway. I'm your host, Jeff Maines. I help B2B SaaS founders like you scale from 7 figures, which is good, to 8 and 9 figures, which is outstanding. Together, we supercharge revenue growth, create premium valuation, and craft a business you're proud of and a life of impact and freedom that you absolutely love. Today, we revisit the old age conundrum of product pricing. It's like a Pandora's box that when open can either shower prosperity or unleash peril, or sometimes a little of both. It's a delicate dance, really, between numbers, perception, and value. And in the rapidly evolving SaaS universe, this dance becomes even more intricate. And if you read my book, you know how great I am at dancing. And if you haven't, I refer to it as my kryptonite in the chapter called Dancing in the Land of Lost Opportunity. You probably guessed by the cover, it's not your typical business book. But the price of anything, from a masterfully made cup of coffee to the most complex software, isn't just determined by costs or margins. It's a measure of the value perceived by the customer. And you mix in a little pinch of market dynamics, a dash of competition, and a hearty spoonful of your brand's unique offering. And that's a fancy way of saying that price is all made up. Is there a magic formula to it? Luke Holman wrote a book, and it's a fantastic book. One of the best books I've read on pricing. And he's got some things in there that are just absolute gold. But at the end of the day, pricing really is made up. It's all about perceived value. There's always a temptation to just mirror a competitor's pricing model. I mean, after all, they seem successful, right? But here's the catch. Their success is a cocktail of their unique value, customer understanding, and yes, their pricing model. It's a cocktail that is uniquely theirs and may not quench your business's thirst for success or be the right flavor for your ideal clients. Back in the early days, before SaaS even existed, Salesforce started, and they didn't mimic the existing software licensing models. They pioneered a subscription model, which is a SaaS industry standard today. I mean, they really invented the whole SaaS model in itself. And that was in tune with their unique value proposition, a customer relationship management solution that was not just powerful, but also accessible and affordable. And so in the early days, they didn't go after the giant companies. They were really going after kind of the next tier down. And so it was something that's accessible, affordable. We didn't have to drop hundreds of thousands of dollars. If you remember something like Siebel, I mean, they were really high end and priced like it as well. And a lot of companies really needed what they have, but couldn't afford it. And Salesforce slid right in there and were able to just nail that market. So the innovative pricing model, complemented by their cloud-based solution, just completely revolutionized the CRM industry. And it's taken, 20 some odd years, but that fundamentally blew up software pricing models. If we look at where they were 20 years ago and today, the pricing models that existed, Salesforce and the SaaS model has just obliterated them. I mean, nobody goes out like, can I buy an enterprise license? Can I give you $500,000 right now for an enterprise license? You just don't see that out there. Now we're seeing a big shift to usage-based pricing, which is really interesting. We've kind of gone and had a big market shift, and now we've got another one that's really happened over the past few years. And we'll continue to see that evolve for sure. We actually did usage-based pricing at Intelligent Contacts 10 plus years ago because it was disruptive. Zero charge for seats. Like, are you crazy? But it started conversations because when we submitted proposals or we would send over, our thing and they would try and compare them, there was no box to put it in. I mean, they had to call us and had to talk to us because it was just ridiculous. Our zero versus $150 a seat was like, what? And they didn't know what to do with that. It was too good to be true, except that it wasn't. And that's what we're looking for, is that huge perceived value for your organization. And every price, every value is perceived. Nothing in the world has actual value. Diamonds, gold, it's all perceived. I mean, you think, those things are really valuable, but the value is in the mind of the buyer. We think gold is valuable because we assign value to it. It's perceived that way. Is it really worth anything? It's a metal and we can make some stuff with it. But value is assigned in the mind of your ideal client. And there's a chapter about that in the book as well. And I want that perceived value of your SaaS to be absolutely off the charts. I want your ideal clients' minds blown so that they have to talk to you because it's so good to be true, except it isn't. And that's just a great, great thing. When they're engaged and they're like, this is so awesome. This is way too good to be true. And you're like, this is the real deal. And that perceived value is one element that translates into premium valuation for your business. Pricing is not just about costs or competitors. It's about understanding your clients, conveying the unique value you bring, and being brave enough to chart your own course, not just copy somebody else's pricing model or copy somebody else's compensation model. This is not a follow the leader kind of game. That's not what entrepreneurship is. It's more like painting a masterpiece where you decide the true value of your art. If you want to skyrocket your perceived value, check out today's sponsor, Champion Leadership Group. Get time-tested principles, growth tools, frameworks, and map out a plan to accelerate your SaaS business from 7 to 8 to 9 figures. Learn to see your business the way an investor, VC, or private equity would in order to build in premium valuation. Travel with fellow SaaS entrepreneurs on your growth journey using a proven methodology that is mentor-guided, results-focused, and peer-supported. Celebrate wins, set new revenue records, and drive your business instead of your business driving you. Supercharge your SaaS growth engine at championleadership.com. Our founder on Tuesday was Dan Fernandez, co-founder of multiple SaaS platforms, including SoStock.com and Thomason.com. He spent 15 years managing and working with overseas coding teams with stellar results. It's a great conversation about how to effectively communicate and manage outsourced or internal remote teams and get the job done. Our expert guest last Thursday, was Z Jeremick, founder and CEO of Mass Engines. Z is a master revenue mechanic and all about building revenue growth engines for SaaS companies to harness the full power of existing marketing and sales investments. Not buying a whole bunch of new stuff, use what you got and make it work really, really well. So the episode will certainly add horsepower to your sales machine. So if you missed either one of those episodes, go back and give them a listen. It's really, really good tips there. My guest this week is Rachel Parrinello, a principal at the Alexander Group. She is a leader in the firm's sales compensation, media sales, and technology practices. In this role, Rachel delivers sales compensation expertise for clients and directs firm's sales compensation IP and benchmarking methodology. Rachel has authored several articles and white papers, including How Revenue Planning Drives Sales Compensation Success. And that is a great article. You've got to get a hold of that one. Welcome someone who drives profitable growth through alignment, Rachel Parrinello. Hi, Rachel. Welcome to SaaS Fuel.
Well, thank you, Jeff. I'm delighted to be here.
Well, today's topic is all about sales compensation. And I think sales hires are one of the hardest things to do. And then once you get them in, how do we keep them motivated enough to do the work, but not overpay, but not underpay? I mean, it's a crazy thing that we have to balance. So I would love to hear, your insights. What are the things that you've seen that have, one, worked really well in sales compensation? And we'll talk about some of the mistakes.
Sure. Yeah. So the best designed sales compensation plans are ones that are market competitive, aligned to your strategy, are motivational, right? So people can achieve their goals, and are well communicated. So those are kind of like some of the key tenets I think about when I think about a sales compensation plan.
It's really interesting how you talked about it being aligned with the goals. And I see that in kind of two buckets. One is the company goals, so things that we want to accomplish, and the other is the reps. And what is it that's really going to motivate them? What's their big why in this equation? So how does that compensation fit into both of those?
Yeah, you're spot on, Jeff. It has to be a win-win. So obviously, companies got growth goals that they need to achieve, and so the sales compensation plan needs to align to those growth goals, whether they be product focus or just overall total revenue growth or whatnot. But from a seller standpoint, they want to make sure that their pay is market competitive. They want to make sure that their upside opportunity is market competitive or even above market, right? So that's a nice way to attract and retain employees if you can have a pay philosophy that says we pay above market at even the OTE levels or TTC levels, and then obviously the upside opportunity. And I think that the third thing is just making sure that the goals that you set, the criteria within which the pay is calculated, are set in a way that they're achievable, right? We need to make sure that they're not just a walk in the park, particularly from a company financial standpoint, because then you're going to be way overpaying everybody. And sometimes that does happen. I've seen it. But you want to make sure that, a seller can actually achieve it. If they don't see the opportunity, then they're going to just tune out and start looking for another job.
I think you're right about that. I think it's pretty rare to have salespeople say it's too easy. I think a lot of times the companies err on the other side and make it just so impossible to achieve those goals.
Yeah, we've seen that definitely in the technology sector. So one of the data points that we track is what % of your sellers are achieving their quota. And it's been tracking very low. Unfortunately, in the last 5 or 6 years, it's around 30 to 40% of sellers are achieving their quota. The philosophy that we would recommend is that at least half or more of your people are achieving quota, because you want people participating in the upside of the plan. And therefore that means that the goals and the quotas you set for them are, like I said, realistic and achievable. And therefore you as a company will hit your number if, enough of your folks are hitting their number. So interesting enough. And one of the reasons why I think there's been a low, what I call participation rate, right? Participating in the upside of the plan, is because I believe that a lot of these startup companies, you've got investors and founders and folks just putting really, like, they feel like they've got the next snowflake, right? And they put these really aggressive top-down goals, aggressive goals on these firms and expecting them to grow by such a high percent. And then they have to allocate that down to the sales force. And that means they have to double or triple their sales force and whatnot. And then you've got a lot of ramping people. You've got, people that, it takes a while for them to ramp up to be able to hit their goals. So it becomes quite a challenge. So that being said, in our last iteration of our database, it did go up to, it was somewhere in the 35%, depending on which cohort we're looking at, pure subscription versus hybrid companies, et cetera, and different phases of growth. But our latest iteration, it went back up to like 40% from 35%. But again, best practice is 50 to 60% of your folks achieving quota.
Wow. Yeah, that's pretty scary. But like I said at the beginning, I think sales hires are very difficult to make. And you probably do have investors putting money in and giving a mandate of here's what the goal is. Or maybe that was in the pitch deck. Here's what the hockey stick looks like. And now, we're going to go try and make it.
Yes, exactly. Although that's changing as we speak with this latest with the market trends going on right now. It's no longer all about growth. It's about profitable growth. So definitely a big focus on profitability these days.
Which I think makes perfect sense. Fundamentals matter. And somewhere along the way, we forgot that. Yes. We're here to make money, not just spend and grow, because it's not sustainable.
So true.
Yeah. Well, as we look at sales, it's one thing to kind of step back and say, this is sales compensation. And as leaders, a lot of times we look at it as a single bucket, but sales is not one bucket. There are different roles within different roles, responsibilities, different jobs. Yes. And so tell me a little bit about how you see that. What are those jobs and how do we clarify the roles around them?
Right. So we use TSAI came out with this format called LAIR, Land, Adopt, Expand, Renew. So very common in any, when you're thinking about recurring revenue, it's not about sell once and walk away and then sell another time. So you have to think about the ongoing relationship you have with your customer over the lifetime of the customer. We added the I at the beginning, identify, with a lead gen, SDR type of role. So we call it the I layer, identify, land, adopt, expand, renew. And so one of the things we do up front when we work with our customers is we'll spell that out and then identify which jobs are responsible for each of those, what we call motions. Because some people will call it a sales process, but I don't think of it as a process because the process isn't linear anymore. Right. And if you're in a consumption model, I would argue, consumption pricing model, I would argue that your adopt, your renew, and your expansion are all happening at the same time. Right.
That makes a lot of sense.
Yeah. Whereas in a subscription, maybe one of those happens before the other. And then I would get even more detailed. So for example, take expansion. There's multiple expansion plays. So you could do, sell more, have more users, more, just more people using your product, depending on your pricing model.
Right.
Or you might be cross-selling, right? So cross-selling a new product to your current customer. And then the third one, the more challenging one, that's a lot like a new logo sale, is actually going to be going out to new departments or new business units within that company. So those are all different sales expansion motions. And so laying that out, because sometimes what you'll find is that we have our core seller, our account executive is focusing on the new logo, the new department, the cross-sell, but we can actually maybe offload, hey, the customer grew and they need to add 100 users. We can maybe offload that to our customer success, our renewal rep, and say, hey, you can do that easy renewal with the upside, with the little upgrade that is aligned to it. So anyway, laying that out and identifying what jobs are responsible for what motions and doing that by segment, SMB and strategic, they may be very different in terms of how you want that sales journey to map to the buyer journey and what jobs you want involved.
That makes a lot of sense. And it brings a lot of clarity, I think, one, for the reps and really understanding what they're supposed to do,
yes,
what pieces they're responsible for, and how they're compensated.
Right.
And one size doesn't fit all. So maybe if you're a brand new company and it's your first sales rep, maybe they do all of that. But certainly as you grow, then those roles and responsibilities separate and should have different comp plans, although sometimes they don't.
Yeah, exactly. That's one point of failure we sometimes see is the company is evolved and there's multiple roles and jobs, yet there's still one single sales compensation plan design. And so obviously you need to align the plan. So like one of the rules of thumb we have is the number of plans you have should be aligned to the number of jobs you have. Now it's a general rule, because many times we'll go into a client and we'll look at by segment, the I layer, and we'll map all the jobs. And it turns out your enterprise AE has the exact same roles and responsibility as your commercial AE. And so therefore they end up being on the exact same plan. Maybe they're different, obviously different pay levels, but the plan design is still a 50-50 pay mix. It's still, new ACV, maybe a multi-year bonus, things like that. So, but yeah, you definitely want to look at the beginning of your plan design cycle or even your go-to-market planning cycle. What you want to do is really kind of reflect on your jobs and what you want these people to be doing, what behaviors are you trying to drive, and making sure those map to your corporate goals, obviously. And then that makes it so much easier when you go into sales compensation plan design, because you already have identified and documented those behaviors you're asking those sellers to do.
And that's really what you want the compensation to be tied to, is driving those behaviors.
Yeah. Now, I will say this is another challenging area for technology companies is if you think about it, particularly with recurring revenue companies, which I know many of the listeners are, there's so many different activities or I guess kind of sales motions or sales initiatives that you want to drive. There's the new logo acquisition. There's expansion. And expansion, like I said, can have different products and things to that nature, as well as just your, increasing your current subscription user base. There's the renewal. You might have one-time services that you're trying to sell, implementation services or training. You also, if you're, you might compensate on ACV, but then how do you treat 2-year deals, 3-year deals, maybe even 5-year deals? So there's the multi-year component. What else is there? There's those are kind of the key things that we see. And so if you think about all those things I mentioned, that could be 7 measures in your plan. That's definitely what we call a Frankenstein plan. And so we have a big rule that no more than 3 main measures in your plan. So if you think about the target incentive, and you're allocating it against a measure, what we call weighted measures, you want no more than 3. And if you can get by with 1, actually that's golden. We would recommend that. And then what we have in technology companies is a lot of what I call non-weighted measures. So these are the add-on bonuses. So you have an 100% new business ACV plan, and then you do a multi-year bonus, to recognize and reward them for landing a 2 or 3-year deal. And then maybe you have a product credit uplift. Oh, you landed this new product, so you get a credit uplift. So there's bonuses, there are credits uplifts. I've even seen credit downlifts for PS or services. I also see add-on bonuses for maybe renewals. Well, they helped out with the renewals, so I'm going to give them a little bonus for that, or an add-on bonus for PS. So it gets really complicated. And what we're seeing, a lot of our technology clients have a lot of these add-on measures. And so going back to that conversation of what % of your folks are achieving quotas. So like I said, we see like 35% achieving quota, but if we look in the data, actually 50 or 60% of them are achieving their target incentive. And so there's this big discrepancy between the quota attainment and the pay attainment, if you will, the payout attainment, their target incentive attainment. So you have to be careful. You need to think about how to measure all those different sales behaviors, but you also need to make sure that you're not overcomplicating or driving issues with the sales compensation plan and your quota setting process, right? So we would recommend that if they're with these add-on bonuses, that they be at least less than 10% of the target incentive, if lower. Sometimes we see that a lot higher. And you could think about other ways to do it, which would be a credit uplift, or you can even do some sort of accelerator hurdle, meaning, your accelerator is 2x, but if you land 4 more new logos, it's 4x or something like that. Or you land, you hit your renewal bucket, then it's, 4x or something like that. So you can do different things in the plan. That being said, we want to make sure that you don't overcomplicate it. At the end of the day, you want to make sure that the plan is simple, easy to understand. And so a lot of times when we work with our clients, what we're trying to help them think about is, what can you measure with performance management and perform, right? As opposed to baking everything in the sales compensation plan. Let's keep the sales compensation simple, but think about our managers and how we want our managers to manage our sellers and have that part of the performance management program. Which I know is hard when you're a startup and you're getting started and you know what I mean? You don't have time to think about performance management, but eventually when you scale, that's definitely something you want to think about.
I think it's important to think about in the beginning, because if it gets too complicated, especially small, it's much more difficult to manage.
Yes.
I think it's fascinating that the reps, even if they're at 35, 40% of their quota, they're finding these other add-ons to get up there where their on-target earnings are where they're supposed to be. That's really, really interesting.
Yeah. So we help kind of rein in those costs with a lot of our clients and think about, okay, what can we bake into the target incentive so that we don't have all these add-on bonuses and things of that nature. One client, I think they had 10 different on-top bonuses that people could earn. Yeah, it's got a little bit out of control. Their plan was simple, but there was all these credit uploads and bonuses and things like that was driving cost to get out of whack.
Just tracking that seems exhausting.
Yeah, yeah. So obviously, well, and even it's interesting in the sales compensation incentive calculation software industry, right? SPM, sales performance management, or EIM, enterprise incentive management. That industry has grown quite a bit, and there's been a lot of new players that have come on board the last 3 or 4 years. So what they've seen is some of the players who've been around for a while are just it's overly complicated and hard to manage. So there's quite a new players that I think some that are pretty reasonably priced that I think a lot of startup companies can look into.
With those tools, do they bring suggestions for how to compensate? Or is that something, I mean, have you seen that a lot where somebody takes a plan from one company and tries to port it over? I've tried that and use it in another one.
Yeah, that is actually one of our number one mistakes that we see clients do. And it's so funny, we'll work with a client and I'll go, wait, where is that leader from? And then I'm like, oh, that plan looks exactly like where they came from.
That's really funny.
It's a really, really bad idea because every company is unique. It's got its own reward philosophy or pay philosophy. It's in its own stage of maturity. Right? Startup versus, more mature companies. And even though they might be in the same industry sector or subsector, they usually have a different product portfolio. They may even have different pricing models. So, as I mentioned before, we talked a little bit about consumption models. Consumption pricing models are on the rise, and all the recurring revenue companies, and even the hardware companies are now getting into consumption pricing models because now they realize, oh shoot, AWS was renting their infrastructure. I could do that too. Although we're going to rent it on-prem. So it's just, and the client will pay for what they use, which is a lovely, pricing model. Well, how great is that? Like, I'm not paying for vaporware. I'm paying for actually what I use. So, so it's on the rise. So we're seeing a lot of, companies changing their pricing model or evolving it. And so that actually has a big impact on your sales compensation measures. So we're big believers on paying for persuasion. And so what that means is you pay for the persuasion activity. And in a subscription world, it's pretty easy. It's the ACV, or it used to be TCV, but everybody's sort of landed now on ACV with some sort of multi-year bonus or credit uplift or something like that to recognize and reward the longer-term deals. But in the consumption model, if it's pure consumption, no committed contract up front, you kind of have to pay on the ongoing revenue. So maybe you have some sort of bonus up front on the contract land to reward that persuasion activity, but the job role is very different. Remember, I was saying the adopt, the expand, the renew happens, all concurrently. So you land the customer, but then once you get them going, you're adopting, and that's driving billings and revenue, and you want to pay on that ongoing persuasion. So the persuasion is very different in consumption-based pricing models and subscription.
It definitely is. And in keeping plans simple, we want to make sure that we're communicating those right, because we're trying to drive behavior ultimately. How successful are most companies in explaining their comp plan where the reps get it and they understand what they're supposed to do and how they're paid?
Yeah, so it's mixed out there. With some of our clients, we do see they have hired people from maybe, other companies, either sales ops or HR, depending on who owns the sales compensation plan. But they have hired people from other companies who've had experience with the communications, or even from consulting firms, right? So they'll hire like an HR person who had experience in some sort of consulting firm. And so they'll be very good and know that it's so important to communicate effectively. But a lot of other companies don't, unfortunately. And the communication kind of falls down, and you ask a seller or even a manager how they're paid, and they start telling you things, and you're like, that doesn't map to what I see on this page. And so there's a lot of confusion out there. So, even the best design plan, if you fail on the communication, you've failed on your plan design, right? So that is extremely important.
Yeah, reps definitely need to understand it in order to to know what they're supposed to do or how they're measured.
Right. And that's actually one of the benefits of some of these incentive compensation calculation software vendors that you can purchase these days, right? Because they usually attach into SFDC or Dynamics or whatever CRM system you're using. You click on the button, you go, and you can even play, a lot of times you can play what if scenarios, like if I land this deal, throw it in, like how am I going to get paid? So having that real-time visibility into your performance actually helps out when the calculations are happening at the end of the month, because you can correct things. Oh, I didn't get credit for this before the payout cycle as opposed to post payout cycle. So there's huge advantages of that. And then also just having the sellers understand how they're going to get paid and how different deals will translate into a specific payment.
That's a long, long way from the old days of spreadsheets.
Yeah.
Or even paper forms.
Yeah. Now, if you don't have a calculation tool or, and your plan is super easy, it's just a simple commission rate, then no problem to make it do it on the back of the napkin. But if you've got all these uplifts and bonuses and different measures, you definitely need some sort of calculator tool to give your sellers, because otherwise they're going to create their little Excel spreadsheet themselves.
I've seen that multiple times.
Yeah.
Where if you don't do it, they're actually pricing the deals and trying to figure out, how do I do this and maximize my compensation?
Yeah. And at the end of the day, you want them to do that. You want them to figure out how to maximize their comp, but you also want to make sure when they're doing that, it's aligned to your goals.
Right.
So, and they're not kind of cheating their way through it, right?
Discounting the thing that they're paid on the least and marking something else up that.
Exactly.
So do you see that a lot where there's pricing games that are being played or they're pricing things too high or too low or, trying to win deals by pricing them low?
Yeah, we do see that a bit, although, 5 or 6 years ago, the industry did move from TCV to ACV. So TCV was very challenging. Well, there's still a few companies, I'd say 90% plus are on the ACV measurement now, but the big justification to move from total contract value to annual contract value was the fact that the term lengths would vary. And if you have varied term lengths, it's hard to set a quote of, is what you do is you say, okay, the average deal value is 100K. We expect you to sell 100 deals and the average term length is 2.3, whatever. And so that lands you to like a $2.3 million quota or whatever. But then all of a sudden somebody says, or somebody is able to land more 3-year deals or 4-year deals than the average. And so they're blowing out their quota, but they're not actually bringing in net new recurring revenue, net ARR into the firm.
Right.
And so that's kind of why the industry has sort of gone towards just an ACV as a primary measurement. Now, there's a few companies that I call kind of an MCV measure. It's a monthly committed contract value, so they usually call it an MRR, but most companies are using the ACV measure. And it's to ensure that the sellers aren't just way discounting out those out years so that they can get that full TCV value. And then there's obviously cost issues with that as well. Right.
Yeah, I think ACV makes a lot more sense because the other revenue is out there 2, 3, 4, 5 years.
Yeah.
Sometimes longer.
Yeah. And it makes the quota setting a lot easier, right? You don't have to worry about that term length.
So as we're looking at simplifying the comp plans, you mentioned, some of them, 7, 8, 10 different variables. How do you pick whether it's the one big variable you want in there or the one factor, or if it's, you said no more than 3, how do you choose which of those to focus on? And does it change?
Oh, yeah, it changes all the time as the strategy changes, as the company changes. And, with today, all the M&A, right? People's portfolios are getting bigger. And so next thing you know, you need to put a product focus measure in the plan. And you might start out with a spiff and then it becomes a hurdle. And then, we got to pull it out as a secondary measure. So what we're big believers in is keep the weighted measures 1 to 3. And then the non-weighted measures, try to keep those down. And non-weighted meaning these bonuses, these credit uplifts, or these hurdles, try to keep those to roughly 3 or as well. And then anything else, just performance managed. Or it might be something you offload to another resource, right? Like you may say, oh, our renewals, we're going to offload that to our renewal rep.
That makes sense.
Just to be very specific, what we tend to do is you bring together a design team that includes finance, sales ops, and HR, and you dialogue about it. What's the most important thing we want these people to do? And that becomes the weighted measures. What are some of the secondary things? Those become the non-weighted measures. And you have a dialogue about it because there's definitely trade-offs. So
I think that's really helpful, having that input from other departments, other team members, and because they not only have influence, they're also impacted by what happens in sales.
Exactly.
Could be special deals or little side things here or there.
Yeah.
Things that they want to focus on that matter to them, make their life easier or harder.
Right. Yeah. So HR would want to make sure the plan design aligns to the reward philosophy. And then finance, obviously, make sure the plan aligns to the financial goals, as well as maybe some of the contracting and pricing terms that they're looking to drive, or even product-oriented financial goals. And then sales ops obviously needs to be there to make sure it aligns to what they can track and measure. We don't want any what we call wishful thinking measures.
Right.
And then you have, obviously, the sales leader needs to make sure that it aligns to the sales growth goals that they're trying to drive, that have been directed to them from, the C-staff, from the CEO and the board.
So in rolling out a new plan, I don't know that most reps are really excited about that. It happens, every year or two. And rolling that out, how is that best communicated in that, it's something that's going to be beneficial for them or beneficial for the company, or it always seems like it's pushed out and this is going to be really good for you, but there's a lot of skepticism.
Yeah. And here's kind of an expression I like to use: commit to the money, but not the mechanics. So what we mean by that is commit to your sellers that you're going to provide market competitive pay, or like I said, above market competitive pay, whatever your reward philosophy is, as well as market competitive upside. But you need to make sure that they know, and most technology sellers have been through this. You go to other industries where they don't change their plans for years and years. It's completely different. It's foreign to them. But most technology sellers are used to the plan evolving and changing as the strategy and the org's changing, and you're specializing your roles and whatnot, right? So, because we all know specialization leads to, or typically leads to, higher productivity. So when it comes to communication, obviously we're big believers that you need to use a change management communication approach. So cascade from the top down. Like you can't just tell the sellers and not tell their manager, because there's going to be a complete disconnect. Manager, what? You're getting paid on that? So you need to make sure it's all the key stakeholders are involved in the design process, that they've been communicated first, and then it goes down through the management chain. Then you, when you get to the sellers, or even to everyone, the communications to strategy should be, all right, what's changed, what's stayed the same. And then with regard to what's changed, if there's anything if it's just more of alignment changes, be upfront with that. We're not trying to change the pay. We're not trying to decrease costs. But sometimes we're doing transformational changes where we do want to, for example, reduce pay on some of these older core products that are not profitable and increase pay on the newer products. So think about hybrid companies moving to recurring revenue models, right?
Right.
So you need to communicate the wins and the losses, and actually I always do that as part of the design process. So for example, we're taking away this bonus. That's a loss for the rep. Think about the wins and losses from a rep standpoint, but we're going to add this, a richer accelerator rate for those that overachieve, right? So kind of, have the gives and takes, and make sure that you clearly communicate that to the sellers, because they're going to figure it out. And so it's best to be upfront and say, yes, I know we're taking this away, but here's what we're giving you, right? So that, I think, is the best approach to use.
So where do you land on capped or uncapped compensation?
Oh, good question. We're big believers, no cap, right? The last thing, I mean, when you're trying to attract top talent, they're going to want to see that. However, if you do have challenges setting quotas, which a lot of companies do, meaning that we may not, like, we're going to be pretty accurate, but there may be some big mega deals that might happen this year, and somebody might be able to blow it away like 4 times their quota or something like that. What you'll need to do is at least have some sort of policy statement that will say, hey, management reserves the right to review mega deals, that are worth at least 1 time a year quota or something like that, and determine the right payout. So that can be something that you can put in from a policy standpoint. Otherwise, if it happens pretty frequently, these big payouts, or wow, the seller really penetrated this territory and blew out their quota, again, it becomes, well, we didn't really set our quotas accurately. So we're big believers in to put what we call decelerator rates in the plan. And so what that would mean is, for example, your accelerator rate goes, 2x above quota. But then once you hit like 200% of your quota, it goes back down to 1.5. So the nice thing about doing a decelerator rate in the plan, it's still and we don't communicate it usually as a decelerator. We usually communicate it as like rate 2 or rate 3. So
right.
We want to make sure it's still an accelerator rate. It doesn't go back to 1x or something like that, which they can just say, oh, I'm going to hold my deals to the next year, to get 1x as I go for the next
that happens.
period. Yeah. And as I think about, my next quarter, my next year, where I could just get up to my target incentive, but it's just not at that very, very rich rate, because the accelerator rate is put there to incent sellers to overachieve on their quota and really earn the big bucks. But at the end of the day, like if they blow it out, like that's, you can overpay your sellers, and then also it can end up being a big cost issue for the company. So you want to manage those big blowout payouts, but still provide incentive to the sellers to keep selling when you have maybe some quota quota concerns.
That does happen, and having the language in there, I think, is helpful. Had that situation come up one company ago, and it was kind of one of those where it was a mega deal that came in. And then everybody's wondering, because, we just won this giant whale, and are we going to go back and change sales compensation now? Or, what are we going to do? And I wrote an $880,000 check for 1 month sales compensation. But that really motivated everybody that this is the real deal, that we can go sell, we can make anything we want to.
Yeah.
But it's really interesting just thinking about are they going to be motivated, or are they just going to be, lazy now? Like I've already made it.
Yeah, Jeff, you bring up a really good point, especially if it's like Q1 and they have the rest of the year, they're going to like sit down. But one thing that I always tell people is you have to be careful. If you overpay your seller and they don't feel that they can earn that much the next year, they're going to start believing that's how much they're worth. And if you can't give them that pay the next year, they're going to try to go somewhere else to get it. So there's a real kind of turnover risk by overpaying, and you have to have really good management. My husband, by the way, is a head of sales, and he's told me multiple times that he's had to have conversations with sellers. You're not going to be able to earn this next year. I just want to let you know your quota is going up. This is, you got it. Congratulations. You got a great whale of a deal, and we're really happy for you. But you have to have that frank conversation and say, you're not going to be able to earn that anywhere else. So, we're going to have to, make sure that your goals are reflecting the potential in your territory, and that you're paid, handsomely, right? You got the market competitive pay. So you really have to manage that.
Yeah, I think it's a good problem to have, but it also, you're right, it is something that needs to be managed and communicated well.
Yeah.
Because those expectations, it's not realistic, to hit a home run every time you're up at bat. It just, it doesn't always happen that way.
No, it doesn't. But one thing that is interesting in the tech industry, I don't know if other industries do this, but it's very common when we work with a project, a leader will say, I need my plan to create $1 million rep, because they, and it's not, sometimes I've been there and it's been $2 and $3 million. I'm like, whoa,
Sure.
That's overpayment. But they want to be able to like showcase the $1 million rep to everyone else and use that as a recruiting tool. Now, not every company does this, and so what we do is we look at historical performance levels, and then we look at the accelerator rates, and we create them so that they could have $1 million rep and they can manage that. And then obviously we curtail it after that so they don't become the $2 and the $3 million rep. So maybe it's 1.1 or 1.2 million. That's fine. And also make sure it's just the 1% or 2% of the population hits that, right? It's not everyone. So, and I don't know. I mean, that's again a reward philosophy that some companies have. So. And then given with today's OTE levels, right? Like a software seller, I think, used to be 260 to 300, but I'm seeing like some of these very senior software sellers make even more than that. So, and if you think about a 50-50 pay mix, so let's just take 300. That's 150. What we typically in target center, what we typically see is the 90th percentile performer should earn 3 times their target incentive. So let's see. So if you have 150 times 3, that's 450 plus 150. So that's about 600K. So that's definitely not the $1 million rep, but that should be where your 90th percentile performer should be earning. At least that's in our database that we track, is that 3x leverage for the 90th percentile performer. And then you'll have some people who go above that.
Yeah, that's really, really good to just have that benchmark. I think that's what a lot of people want to know is just, what should those targets be? And we've seen compensation just all over the map where, it's high salary or sometimes low salary and huge bonus, huge commission. Mm. We've seen the 50-50. We've seen some where on target earnings are, pretty close to 7 figures. And is it realistic? Who knows? But that's what the company is pitching their reps, right?
Oh, interesting. Yeah. Excuse me. For the in the software industry, the AE, the average pay mix is definitely 50-50. So so you're seeing some companies sway away from that. That's interesting. That's pretty uncommon.
And you never know whether it's, if you're getting 40% quota attainment, they could say anything and they're not going to pay it out anyway. Right. So you never really know what is the real compensation. How does it work in the real world? Yeah,
right. Because if not enough people are achieving their goals, then they won't be achieving that target amount. Or if it's a walk in a park goal, they'll be blowing that amount out. So, and that's definitely, a lot of times what I hear, at least, and smart sellers will ask that question: what does the top performer typically make? What percent of your folks typically hit their goals, right? They'll ask those types of questions. So it's good to have that data and be aligned to the market.
So is there something, a magic solution to knowing whether a rep is going to be productive and make quota, or is it just kind of roll the dice and hope past performance, or what at least they tell you what past performance is indicative of future performance?
Yeah, that whole recruiting engine. Gosh, I don't know. I would say do your due diligence and check out their references. I think that's really the best way to determine whether or not this is a winner and you really want to hire them, or if they're blowing smoke.
Sure. Yeah, sometimes the best sale they make is in the interview.
Oh yeah. Well, salespeople always sell. That's what I like. I always talk about quota relief. You have to be careful giving quota relief, because the sales, if they get wind that you do that as a practice, they're going to sell you why they need a lower quota, why they need relief. So yeah, salespeople, that's what they're good at.
It's been a great conversation. Where can people learn more about you and about the Alexander Group online?
Oh, sure. So you can definitely reach us on our website, alexandergroup.com. We've got articles, we've got other podcast webinars that you can look at there. You can also feel free to reach me, Rachel Parrinello, on LinkedIn. Happy to chat with anyone further if they have any specific questions.
Excellent. And there's so much great resources, so many great resources and research on the site. I mean, it's a great site. You guys do a really good job.
Oh, thank you, Jeff. Appreciate it. Yeah, we have a pretty big group of consultants that are working on sales compensation plans all the time. We do more, by the way, than just sales comp plan design. That's about 40% of our business and how we got started. But a lot of our clients come to us with sales coverage, sales strategy, sales segmentation, territory design issues. And so we do all those types of initiatives as well. So
that's fantastic. We'll make sure and link all of that in the show notes for sure.
Sounds great. Thank you. I appreciate it, Jeff. And thanks again for your time. This is fun.
It's great talking with you. Thanks, Rachel.
All right. Take care. Bye.
Thanks again, Rachel, for coming on the show and sharing your insights and wisdom. I'll tell you, it is super helpful to have someone at your level who advises SaaS giants to share with us your research and specifically what is working today in pricing and sales compensation. All links, highlights, resources, full show notes are available at saasfuel.com. We'll also link the study that Rachel referenced there as well. While you're there, subscribe or follow us on whatever platform you love, and be sure to check out our new YouTube channel as well. Long form and short form content there. Everyone who subscribes this week gets an inflatable pricing strategy dartboard so you can enjoy a round of target practice while determining your next pricing model. Join us next week, Tuesday, Independence Day, where our founder is Charles Darrow, CEO and co-founder of Bzop. You heard it right, Bzop. It's a process management software. If you want freedom as a founder or leader, it all starts with solid processes, and they're doing some really cool things. There's a unique story as well. And on our SaaS Fuel Expert Series next Thursday, we have Nicholas Means. Nicholas loves nothing more than a great story of engineering triumph, except for maybe a story of engineering disaster. But he leads an engineering team at SIM, and they help create the building blocks for engineering teams need to build delightful, just-in-time access workflows. It's a great discussion, so much personality and unexpected twists and turns in that episode. So I will see you next week. Happy American Independence Day. Happy July 4th. And as always, get out there, have some fun, go celebrate, barbecue, shoot some fireworks off, celebrate freedom, and enjoy the journey.
Thanks for listening to SaaS Fuel. Full show notes for each episode, which includes a summary, key takeaways, quotes, and any resources mentioned, are available at saasfuel.com. Be sure to follow and subscribe wherever you listen to podcasts. And if you're enjoying the content and getting value from these episodes, please leave us a rating and review at ratethispodcast.com/SaaSfuel. We'll be sure to read these out on future episodes.